Long summary on Stephen Cohen's investments in Apple and Axon. Stephen Cohen, the founder of Point72 Asset Management, runs a hedge fund that has generated $38 billion in profits since its inception in 1992. This makes him the 12th most successful hedge fund manager in history, according to LCH Investments. In the third quarter, Cohen made notable moves by selling his entire stake in Apple, NASDAQ, AAPL, which was previously his second largest holding, excluding options. At the same time, Cohen began a small position in Axon Enterprise, NASDAQ, Axon, a company involved in artificial intelligence, AI, that has increased 500% over the last 30 months. Although the position in Axon is relatively small, this decision reflects Cohen's greater confidence in Axon compared to Apple. Apple, the stock Cohen sold in the third quarter. Apple has built a powerful brand through its engineering expertise and has a strong presence in the consumer electronics market, particularly in smartphones, where it maintains a leading position in terms of revenue. Additionally, the company has seen growth in its services sector, benefiting from high consumer loyalty. However, Apple is facing several challenges that could impact its profitability in the coming years. Apple has experienced a significant loss in market share in China. In the most recent quarter, iPhone sales declined by more than 18%, and Apple failed to rank among the top 3 smartphone vendors in China for 2024, despite leading the market in 2023. Moreover, Apple could potentially lose up to $20 billion in annual services revenue if a federal judge rules against the deal that allows Alphabet's Google to pay Apple for default search placement in the Safari browser. The decision is expected by August 2025, but a lengthy appeals process could follow. Analysts estimate that Apple could see a 4-6% reduction in profits if this deal is prohibited. Furthermore, despite the introduction of new AI features called Apple Intelligence in October, which were expected to spark a major iPhone upgrade cycle, there has been little consumer response. Craig Moffett of Moffett-Nathanson pointed out that there is no clear sign of a significant upgrade cycle, and there is growing evidence that consumers are indifferent to the AI functionalities in Apple's new products. Finally, Wall Street analysts forecast a 9% earnings increase for Apple over the next year, but the company's current valuation of 33 times earnings looks expensive. Despite a 72% return on Apple's stock in the last 2 years, its price-to-earnings ratio has also increased by 72% over the same period, suggesting that the stock has risen mainly due to multiple expansion rather than earnings growth. Investors are advised to avoid this stock. Axon Enterprise, the stock Cohen bought in the third quarter. Axon Enterprise is a public safety company that collaborates with U.S. law enforcement, the federal government, commercial businesses, and certain international governments. While Axon is widely known for its Taser brand of conducted energy devices, the company also offers body cameras and sensors that integrate with software for digital evidence management, reporting, and real-time situational awareness. Axon has incorporated several artificial intelligence features into its software products, including automatic transcription and redaction of video evidence and automated license plate recognition. One of its latest AI innovations, Draft One, uses body camera footage to draft police reports. Draft One has already generated a $100 million revenue pipeline faster than any product in Axon's history. In the third quarter, Axon reported strong financial results. Revenue increased by 32% to $544 million, driven by strong sales in tasers, body cameras, and digital evidence management software. Non-GAAP earnings grew by 19%, reaching $1.45 per diluted share. The company also raised its full-year outlook, projecting a 32% revenue growth in 2024. Axon remains the market leader in tasers, body cameras, and digital evidence management software, with strong momentum in drones and robotics. CEO Rick Smith emphasized that the company is positioning itself as the indisputable leader in delivering AI-powered solutions in practical, usable applications. Despite its success, Axon has captured less than 3% of its $77 billion addressable market, leaving ample room for growth. However, the company's valuation is a concern. Wall Street expects Axon's earnings to grow by 22% annually through 2025, which means the current multiple of 120 times adjusted earnings looks expensive. Despite this, Axon has consistently exceeded earnings expectations, beating consensus by an average of 34% over the last 6 quarters. If this trend continues, the stock may be considered fairly valued in hindsight. For risk-tolerant investors with a time horizon of 3 to 5 years, Axon could be an appealing investment opportunity with potential for future gains despite its current high valuation. Investment opportunities and final thoughts. Cohen's strategic shift from Apple to Axon highlights his evolving investment outlook, particularly in AI-driven companies with growth potential. While Apple faces significant headwinds, especially in China and its services business, Axon remains well-positioned for continued growth with its leadership in public safety technology and AI integration. However, investors should be mindful of Axon's high valuation and consider their risk tolerance before investing.